Interest is not the price of money. That idea alone upsets most explanations you've ever heard. Interest is the price of time being pushed around. Right now, while you're watching this, a handful of decisions made in quiet rooms are determining how expensive next year will feel. Not just for investors, for renters, for workers, for governments already buried in promises they haven't paid yet. We're told this is about inflation, about prices, about stability. That's the polite version. The real story is simpler and more uncomfortable. Interest control is how modern economies tell people when to move and when to freeze. Let's slow this down. Imagine a very small world. No stock market, no central banks, just people and time. You work. You earn money today. You can use it now or later. That's the entire foundation. Now add borrowing. Someone wants money today instead of waiting. Someone else is willing to wait. Interest is the compensation for waiting. I'll give you access to the future, but you pay me for skipping time. That's it. That's the logic. Nothing mystical. But here's the twist. When this simple deal spreads across millions of people, it stops being personal. It becomes a system, and systems don't just reflect behavior. They shape it. At scale, interest becomes a signal. Low interest whispers, go faster, borrow, expand, take risks, don't worry too much about tomorrow. High interest whispers something else. Slow down, wait, save, cancel plans, survival first. This is why interest control matters more than almost any law. It doesn't ban behavior. It doesn't command obedience. It just changes what feels sensible. Now enter the central bank. Most people think central banks respond to the economy, as if they're watching from the sidelines. They're not. They're holding the thermostat. They don't control how hot or cold the world wants to be. They control how expensive it is to turn the heater on. And interest is the dial. Let's talk about now. Why does this topic matter right now? Because for more than a decade, time was cheap. After financial crises, after pandemics, after shocks, interest rates were pushed down, sometimes to zero, sometimes below. Borrowing felt painless. Governments borrowed trillions. Companies borrowed billions. Households borrowed because everyone else was doing it. Growth returned. Markets celebrated. But something else happened quietly. The entire system became dependent on cheap time. Projects that only made sense with low interest multiplied. Debt piled up on the assumption that waiting would always stay affordable. That assumption is the core risk. Because interest doesn't need to rise much to cause damage. 1% sounds tiny. But compounding doesn't care about vibes. A company with thin margins suddenly can't refinance. A homeowner's monthly payment jumps. A government's interest bill explodes without spending a single extra dollar. This is the uncomfortable math nobody likes to advertise. Debt doesn't break when interest is high. It breaks when interest changes. And central banks know this. That's why interest control is cautious, slow, almost theatrical. Every statement is analyzed. Every word is dissected. Not because markets are dramatic, because markets are fragile. Now let's strip away the hype. We're told interest rates fight inflation. That sounds noble. But interest doesn't remove money from the system. It changes behavior. Higher rates don't destroy cash. They discourage action. Borrowing slows. Hiring pauses. Spending hesitates. Inflation cools because people hesitate. That's not a technical solution. That's a psychological one. Interest control works by making people uncomfortable enough to stop. And yes, that includes people who didn't cause the problem. Here's the irony. When times are good, low interest encourages debt. When times turn bad, high interest punishes it. The same system pushes you forward, then asks why you didn't stop. That's not accidental. Debt-based economies require confidence. And interest is how confidence is regulated. Too much confidence creates bubbles. Too little creates recessions. Central banks aren't aiming for perfection. They're aiming for containment. Now zoom out. Interest control doesn't just affect individuals. It reshapes power. When interest is low, asset owners benefit. Stocks rise. Real estate inflates. Wealth grows quietly. When interest rises, wages lag. Jobs disappear. Small businesses struggle. The gap widens without anyone announcing it. No vote. No reform. Just math. This is why interest rates feel abstract but hurt personally. They operate above politics but below daily life. And this brings us to the most uncomfortable part. Modern economies are addicted to growth. Growth requires borrowing from the future. Borrowing from the future requires faith that tomorrow will be larger than today. Interest is the test of that faith. Low rates say, "We believe the future can handle this." High rates say, "We're no longer sure." Right now, the world is in that uncertainty. Inflation showed up. Rates rose. Weak structures started creaking. Not because they were evil, because they were fragile. And fragility doesn't announce itself during good times. It waits. Here's the quiet absurdity. Interest is presented as a neutral technical tool, but it decides which countries can afford their promises, which businesses survive a slowdown, which generations get opportunity, and which get bills, all without asking permission. So the next time you hear that interest rates are just economics, remember this. They are a way to control speed without touching the wheel, to shape behavior without issuing commands, to manage risk by redistributing pain. And the final question isn't whether interest rates will rise or fall. It's this: how long can an economy built on borrowed time keep rearranging the future before the future stops cooperating? Because when waiting becomes too expensive for everyone at once, interest doesn't guide behavior anymore. It exposes limits. And limits are something no central bank can lower.